Hello and welcome to Wealth Quest, the show that gets to grips with the world of portfolio management. I'm Samantha. On this week's show, we're reviewing a recent paper written by our very own Roland Rousseau. Now, the report looks at the evaluation in the local market and asks how stretched valuations really are. The paper explores valuation metrics not often utilized, and the outcomes of these we'll be discussing in today's show. Well, of course, joining us for this discussion, Roland Rousseau from ABSA Capital and Cobie Legrange from ClucasGray Investment Managers. Thanks for joining us. Roland, you're in the hot seat today. So, of course, you talk about why markets correct. That's what you start off talking about. And many say it's because essentially the market is expensive, but you have a different thesis essentially.
Yeah, I think historically most people have looked at the market from a valuation perspective, which is called fundamental analysis. So you look at certain metrics such as dividend yield or price to earnings ratio or price to book, and you're trying to see what price the market, what price relative to the book value or the earnings of the market is justified when you compare that through periods historically. The problem with that kind of analysis is that we find periods where markets can remain expensive for very long or even go up after they're expensive even more. So there's a new approach globally which bases itself much more on measuring risk appetite and sentiment in the market, or how people are how keen people are to take on risk. And I guess in a nutshell, to summarize up this kind of approach is to say markets don't correct when they are necessarily expensive. They correct only when risk appetite changes. And when you look at the market in that way, you have to use different metrics to try and understand when it is expensive and when it is cheap, because the valuation metrics don't work as well as they used to.
I mean, I want to again say there what Roland said just now. He said when the risk appetite changes, and I think that is so important for markets because, yes, valuation drives markets often to heady kind of levels, but when the risk appetite for these things changes, then you often have money flowing from these things. And people often in the market try and find the levers for those. And people often try and say, well, we think this might achieve this, or we think that might achieve this. But I think Roland has gone and actually done some research on the South African market, which potentially could shed light on the valuation in the market. And maybe for you just at home, the valuation at the moment for the market is running at about 17 times earnings at the moment. That's the price to earnings ratio for the market. We were as high as 17.8 a couple of days ago, and we're sitting roughly at about 17 times earnings at the moment. Let's take you through two graphs from that study. The study aptly named short-term reversal in early 2014. And there you can see the very first one of those charts. Roland, just take us quickly through that.
Okay, in effect what we're looking at here is a kind of Sharpe ratio equivalent, and all that is it's looking at the risk and the returns relative to each other, and we're looking at bonds and equity here. So the dark line is the excess return that you are getting over and above bonds, and the blue line is the relative risk of equity to bonds, and it's a rolling graph. So in effect, at the end there of that graph, you can see a diverging trend, and this is concerning because you are seeing higher and higher relative returns from equities to bonds for lower and lower relative risk. And generally we know that equities are supposed to be more volatile than bonds, but the relative risk is below average, that sort of dotted horizontal line in that graph. So this is not sustainable. We can't have higher and higher returns for less and less risk. And that means that at some point, probably in the next 6 months, we are going to see this kind of trend reversing, which can only mean that either equity volatility goes up or equity returns come down. And
so are you expecting those two blue lines to revert to that dotted line?
Well, they're going to cross it, but by crossing it, they have to diverge in the other way. So they have to reverse their current trend. And as I say, the only way that can happen is if equity volatility goes up. And generally, when equity volatility goes up, the market is probably going to crash. And I'm certainly not predicting a crash here. And the other way for that to happen is that the returns of equities relative to bonds gently come off. So we're seeing we're not seeing the kind of returns that we have seen in the last year again over the next 6 to 12 months coming through.
Without getting too technical, talk to us about how you measure excess return.
Okay, excess return is just the the return of equities to cash, and the excess return of bonds is bond returns minus cash. So it's and then we measure the volatility of those excess returns for equities and bonds.
Yeah.
So it's just a way to strip out the interest rate cycle. So by removing the cash returns, you are removing the effect of interest rates on those asset classes.
Maybe to make more sense out of this is let's have a look at how this picture actually looks for the global economy, because once you can understand what they look like for global stocks, you can actually understand how expensive South Africa is. So just have a look at your screen there quickly. And what we're doing, or should I rather say what Roland is doing over here, is he's looking at the MSCI, which is really a conglomeration of companies, large global companies relative to the World Government Bond Index. And the World Government Bond Index is obviously very large scale top bonds globally. Now, if you have a look at the excess return over here, there you can see the dark blue line. That's the excess return for equities over bonds relative to the actual risk that you're assuming for that, or the volatility relative to the two. And you can see the two are far more in line. Let's go back to the South African picture, and you can see the gap between the two. There's a far larger gap between the two.
So does this mean South Africa's market is more vulnerable right now?
The equity market relative to bonds is much more vulnerable now, because that relative risk that you saw there is at literally a low that we haven't seen before. So you are getting a free lunch at the moment. You're getting massively high returns from equities with very little volatility relative to bonds. In fact, equities nearly have the same volatility of bonds, when historically they should have much higher volatility because they're equities. Mm-hmm. And in the European situation, we are seeing also higher returns, but at least they are associated with higher risks, which makes sense, but not in South Africa.
Mm-hmm. Yeah, and I mean, look, this is off the back end of an emerging market story. So 5 years you've had inflows into emerging markets. I'd probably argue that India and South Africa have had a lot more inflows than some of the other emerging markets, but South Africa certainly has been a recipient of that. So you're just sitting again or valuations that are just at unsustainable levels. And if you look across the board, and this is the interesting thing, is that you're actually sitting with quite a disparate market, because you're not sitting with all companies that are expensive. Rand hedge counters are often quite expensive, but there's a whole bunch of other counters that I could probably argue is probably fairly valued at this stage, but there's risk associated with actually being invested in those counters, because if the market has some form of correction, it's going to sell right across the board. It's not necessarily just going to sell in the one set of counters.
Let's quantify the magnitude of the sell-off that you're predicting into 2014.
Yeah, look, the good news is that, yes, there is a divergence in this, and that is not from a risk appetite perspective going to last. But the magnitude of this is not as bad as, in previous times. We'll have a graph to discuss that a bit later on. But the point is that we're looking at about a 10 to 15% correction over the next 6 months. If this kind of relative risk mean reverts or gets back to its sort of long-term equilibrium levels. Mm-hmm. But what makes us different is that we're looking at the risk appetite in the market, whereas most of the times we tend to ignore that. And the fact that in South Africa, and Cobie hit the nail on the head, that we have such high equity returns is not a South African effect. It is an emerging market effect, and a lot of the companies in our market happen to be driven by this. The South African breweries, the BTIs, the NASPERS, they are all artificially inflating our market's returns, not because of South African reasons, because of emerging market reasons. But it's more extreme in South Africa relative to domestic bonds than in other regions.
Yeah. One of the things, that I find quite interesting about the research is that you take equity returns and you break them down into two big factors, one a rational factor and one an irrational factor, or what should we rather say, a rational component and an irrational component. Do you maybe want to just take us through the methodology for that and what that means for equity returns?
Yeah, if you think about the market, if the market goes up 20%, what is driving that 20%? There are probably variables such as the rand, commodity prices, foreign equity markets. There's a whole slew of these kind of things. So what we do in our analysis is we go and say, we want to explain, and this is using a concept called regression analysis, where we want to understand how much of that 20% is coming from drivers that we can identify and that are rational. We know that the rand is going to have an impact on the market. We know that interest rates is going to have an impact on the market. But there's a portion that we cannot explain. So we might be able to explain 70% of the market's returns, but that 30% that we're missing is actually at the margin, the irrationality in the market. It is the part we can't explain, and it's that part that we are very interested in, because if that irrational residual or part we can't explain gets too big, it means that something else is driving the markets than the rational drivers or the common economic variables. And that's concerning. And we're seeing a little bit of that on the graph there. You can see right at the end there a little spike there, and that's why we're not too concerned about this kind of sell-off. But it's telling us that the market is definitely in an irrational phase. Whenever that line is above zero, that shaded blue area, you are in a period where the market is running harder than these variables can justify. And we don't like that generally. And you can see there are many cycles that the market goes through. Some are large and some are small. We're having a small cycle at the moment.
So it's slightly irrational, is what you're saying?
Slightly irrational, but definitely it's turning around, as we can see. And that divergence that we showed earlier on is another contributing factor that is making us concerned. So this is a 6-month kind of analysis and would make us probably want to pull back from putting more money into the equity market.
And you said 14-15% is what we're looking at in the next
10 to 15%.
10 to 15% in the next 6 months.
Often what happens in markets is when markets are really cheap, you've got the early adopters, people that know that the market is going to start going up again at some point. The early adopters drive the first portions of the returns. It's always what I call kind of the free part of the market, because nobody's really interested in investing because they think the market's going to go even lower. That's the early adopters. Once the early adopters have made their money, the next phase comes into the market. But by the time the late adopters come into the market, you're literally sitting in a situation whereby you're starting to run off a cliff. And that, I think you're seeing a little bit of that in the market at the moment with these stretched valuations and so on. And people trying to say, well, maybe what you should be doing is we should be pushing the valuation slightly back so we can start having potentially the next run.
And then just to end this off, Roland, I mean, because you're looking at the South African market, as you say, slightly irrational, looking at a 10 to 15% sell-off. Where would you say the S&P is relative to its risk metrics and where risk appetite is there right now?
Well, in America, the situation is that we are getting good returns from the market, and there is proportionately higher volatility in those markets as well, especially with this kind of Fed taper on off and the volatility in the dollar is all contributing to volatility. So that higher return is justified from a risk perspective. So there isn't that kind of stretched difference. There's no free lunch there. You're getting higher returns, but it's more volatile. In South Africa, we're getting the reverse, and that's the difference. So the American situation isn't looking as bad as the South African is. Yeah.